Equipment financing is a specialized type of business loan that helps companies acquire the machinery, tools, and assets they need to operate and grow. This form of financing is particularly valuable because it allows businesses to obtain expensive equipment without depleting their cash reserves. Throughout this lesson, you'll learn how equipment financing works as a secured loan, the types of equipment that can be financed, and why this option can be more accessible than traditional business loans. Equipment financing is a secured loan specifically designed to help businesses purchase equipment and machinery needed for their operations. The key feature that makes this type of loan unique is that the equipment itself serves as collateral. This means the asset you're purchasing acts as security for the lender. Because the loan is backed by tangible collateral, lenders view it as less risky compared to unsecured loans, which often results in better terms and easier approval for business owners. Equipment financing can be used to purchase a wide variety of business assets across different industries. Heavy machinery includes construction equipment, tractors, and industrial machines used in manufacturing. Technology encompasses computers, servers, software systems, and IT infrastructure that businesses rely on daily. Medical equipment covers diagnostic tools, treatment devices, and laboratory equipment for healthcare providers. Vehicles include commercial trucks, delivery vans, and fleet vehicles necessary for transportation and logistics. Essentially, if it's essential to your business operations and has value, it can likely be financed through an equipment loan. Understanding the mechanics of equipment financing is straightforward. First, the equipment you're purchasing serves as collateral for the loan, meaning it secures the lender's investment. If you fail to make payments as agreed, the lender has the legal right to repossess the equipment to recover their losses. Because of this secured nature, equipment loans typically come with lower interest rates compared to unsecured financing options. Additionally, the loan term is usually structured to match the equipment's useful life, so you're not paying for the asset long after it becomes outdated or needs replacement. This alignment helps ensure the financing makes economic sense for your business. Equipment financing offers several significant advantages for businesses. First, it helps preserve cash flow by allowing you to spread the equipment costs over time rather than making one large upfront payment. This keeps your working capital available for other operational needs. Second, there are tax advantages, as interest payments on the loan and equipment depreciation may be tax deductible, though you should consult with a tax professional for your specific situation. Third, securing approval is often easier compared to other loan types because the equipment itself reduces the lender's risk. Finally, equipment financing enables you to stay current with technology and industry standards by making it affordable to upgrade equipment regularly without major capital outlays that could strain your finances. It's important to distinguish between equipment loans and equipment leases as they serve different purposes. With an equipment loan, you own the equipment once the loan is paid off. You build equity over time, and the equipment becomes a business asset on your balance sheet. In contrast, with an equipment lease, the lender retains ownership of the equipment throughout the lease term. Leases typically offer lower monthly payments since you're essentially renting rather than buying. Leases also make it easier to upgrade to newer equipment when the lease term ends. The choice between a loan and a lease depends on your business needs, whether you want to own the asset long-term or prefer flexibility to upgrade regularly. The application process for equipment financing follows a logical sequence. Step 1. Identify the specific equipment you need and obtain a quote from the vendor or manufacturer. This gives you a clear target amount for financing. Step 2. Apply with a lender, providing your business financial statements, credit information, and details about the equipment you wish to purchase. Step 3. The lender evaluates your creditworthiness and assesses the equipment's value to determine if it's adequate collateral. Step 4. Upon approval, the lender typically pays the vendor directly for the equipment, and you take possession and begin using it immediately. You then repay the loan according to the agreed-upon terms, usually through monthly installments. Before committing to equipment financing, consider several important factors. Default risk is real. If you miss payments, the lender can repossess your equipment, which could disrupt your business operations significantly. Equipment depreciation is another consideration, as the equipment's value decreases over time while your loan balance follows a set repayment schedule. This means you could owe more than the equipment is worth for part of the loan term. Always compare rates and terms from multiple lenders to ensure you're getting competitive pricing. Finally, ensure the equipment purchase aligns with your overall business growth strategy. The asset should contribute to revenue generation or operational efficiency that justifies the financing cost. Make informed decisions based on your business's financial health and long-term goals.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.